بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على سيد المرسلين سيدنا محمد وعلى آله وصحبه أجمعين. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي. First of all, thank you very much, Dr. Ildus, for your introduction. Jazakumullahu khairan. And also, I would like to extend my thanks to the Maqāsid Institute for giving me this opportunity to present this topic in the monthly research forum. So the topic today, just as a brief background about the topic, it's actually part of my PhD work. In my PhD work, I focused on the structuring of Sharia compliant additional Tier 1 and Tier 2 regulatory capital instruments. And the focus in the PhD was on the discussion among Sharia scholars and their contemporary views on how to structure a Sharia compliant additional Tier 1 and Tier 2 instruments. So I didn't compare between the Sharia perspective and conventional perspective, but focused on the discussion among Sharia scholars. But here in today's topic, I will also compare between the conventional perspective and the Sharia perspective when it comes to the eligibility criteria for regulatory capital instruments, specifically additional Tier 1. Because in regulatory capital instruments, we have additional Tier 1 and Tier 2, but the focus will be on the additional Tier 1 only. Okay, so this is the title of the talk, and then we can discuss a little bit about the outline. So the outline of the presentation, first, I'll talk a little bit about the objective of wealth protection. In Arabic is Maqsadu Hifz al-Mal, from the Sharia perspective, and also from the conventional perspective, what the conventional system says about wealth protection or how they approach wealth protection. Then I'll talk a little bit about the capital components under Basel III, because additional Tier 1 comes under the capital components of the bank. We have common equity, additional Tier 1, and Tier 2. So we will discuss a little bit in general about the capital components. And these capital components, they apply both to conventional banks and Islamic banks. And once we get an understanding of the capital components, then we can focus our discussion on 4 key elements by comparing these elements between the Sharia compliant AT1 instrument and the conventional AT1 instrument. So we'll talk about the nature of the instrument, the hierarchy of the instrument, coupon payment in the case of the conventional instrument, and the profit distribution in the case of the Sharia compliant instrument. And finally, the loss absorption mechanism for the instrument. And we will reach a conclusion. And if there is enough time, I will mention a very simple example of a real case that happened in the conventional world and how the additional Tier 1 instrument behaved. We'll start first with talking a little bit about the objective of wealth protection, Maqsadu Hifz al-Mal, from the Sharia perspective. So under this objective, there are several general objectives, and I'm going to only talk about one as an example. And the one that I'm going to talk about is circulation. In Arabic, it's called rawaj. And if we want to define rawaj, it's the availability and movement of goods and services in the market, or the distribution of goods and services among the members of the society. And there are many verses in the Quran, many ahadith by the Prophet ﷺ that point to this general objective. So one of the verses, for example, in Surah Al-Baqarah, in the longest verse in the Quran, there is a text that says, إِلَّا أَن تَكُونَ تِجَارَةً حَاضِرَةً تُدِيرُونَهَا بَيْنَكُمْ. So, and the translation of this it's like a ready merchandise which you can transfer directly to one another. So it's talking about buying and selling, which is part of trade, part of doing business, which will also support rawaj, the distribution of goods and services. Another verse in the Quran, in Surah Al-Muzammil, Allah subhanahu wa ta'ala says, وَآخَرُونَ يَضْرِبُونَ فِي الْأَرْضِ يَبْتَغُونَ مِنْ فَضْلِ اللَّهِ. And the translation of that is, some of you traveling through the land seeking Allah's bounty. So those who do business, they travel, they buy and sell. And this happens to be also the verse that is used to legitimize mudaraba, which will be also the focus of our discussion. Now, when we come to the ahadith of the Prophet sallallahu alaihi wasallam, there are many ahadith that prohibit certain market practices. For example, the Prophet alayhi salatu wasallam says, "La yahtakiru illa khati." So, no one hoards but the sinner. The meaning of this hadith. Or when the Prophet sallallahu alaihi wasallam says, "Man ghashana falaysa minna." Whoever cheats in conducting his business, he's not among us. And also the prohibition of the Prophet sallallahu alaihi wasallam from prohibiting a buyer from meeting a caravan outside the market of the city before that caravan reaches the market, so that to avoid deceiving the tradesmen in the caravan from selling at, for example, a lower price than what is in the market. So all of these ahadith verses, they support the concept of rawaj, the movement of goods and services. Then, of course, we have the institution of zakah, we have the institution of sadaqah, we have also the institution of waqf. All of these institutions, they encourage members of the society to circulate wealth, and so that wealth will not be concentrated in the hands of the few. So this is all supporting the general objective of rawaj. Then we have the second layer. The second layer here is what we can call legal maxims, which is in Arabic al-Qawa'id al-Fiqhiyya. And these legal maxims are actually principles derived from the Sharia, and they provide a framework for interpreting and applying Islamic jurisprudence to financial transactions. These maxims, they also provide guidelines that embody the objectives of the Sharia. So they are linked with the general objectives of the Sharia. And they are also derived from the Quran and the Sunnah. And one example of these legal maxims is al-ghurmu bil-ghun. It's very well known maxim, and there are many more when it comes to financial transactions. The translation of this legal maxim is that liability accompanies gain, which means that if you are expecting profit, you also must accept the responsibility in case of loss. So as long as you are liable, then your gain will be justified. So as a result of this, if you are entering into mudaraba contract, there cannot be a clause or a condition that will guarantee the capital of mudaraba, because in this case, you are not accepting the responsibility of loss, and as a result, you will not be entitled to the profit generated by the mudaraba venture. And finally, the third level that comes under the objective of wealth protection are the specific Sharia rulings. The specific Sharia rulings also support the legal maxims, are in line with the legal maxims, and they also support the general objective of rawaj. So in the case of mudaraba, it is a profit-sharing contract. So the capital provider and the entrepreneur will share the profits and the losses will be borne by the capital provider only. And mudaraba can be restricted or unrestricted. And there are many conditions and clauses associated with mudaraba. So these form the specific Sharia rulings related to the contract of mudaraba, which are in line with the legal maxims and also in line with the general objective of circulation. So that's why I chose an image of a tree, whereby these three levels, they are like a fertile soil, and you plant a seed in this fertile soil, and the end result will be a tree full of fruits. And this is how the system works. Now, coming to the conventional perspective, the conventional perspective it's based on also three levels or three layers. First layer is the efficient allocation of resources. And by this, we mean the transfer of savings to productive investments. There are people who have savings, and there are people who have investment opportunities, but they do not have the money. So in order to ensure the efficient allocation of resources, there has to be a middleman, will be the banking, which will be the financial institutions. The banking institutions or financial institutions to transfer savings to certain projects and certain investments and ensure that the resources are allocated in an efficient way. And there are several economic theories on which this general objective is based. You have allocative efficiency, the efficiency principle. I'm not going to go into details about this, but this is we can say, the general objective from the conventional perspective, which is somehow not very different or does not diverge very much from the objective of circulation, the movement of goods and services and the circulation of wealth in general. There are some similarities. There is some common elements or some common ground between the two. And then we move to the second layer. And in the second layer, we are talking about the Basel framework. And this Basel framework is actually established by the Basel Committee on Banking Supervision, BCBS, which is a set of standards. This set of standards aimed at ensuring the stability of the banking system, of the financial, of the banking institutions. And basically, the Basel framework consists of three pillars. The first pillar is the minimum capital requirements. Our topic today is focusing on a small part of pillar 1. And then you have a supervisory review, pillar 2, and market discipline through disclosure is pillar 3. And the Basel framework was first introduced back in 1988. Basel 1, then you have Basel 2 in 2004, then you have Basel 3 in response to the financial crisis of 2007, 2008, was introduced later after the financial crisis, and now they are still developing or revising the framework. Some say now we are in Basel 3.5, and maybe Basel 4 will come soon in the near future. And so this is the second layer. And the third layer is the specific requirements. We can talk about specific requirements related to pillar 1 of the Basel framework. And these specific requirements are focusing on the bank's regulatory capital, which is the ratio of the bank's regulatory capital to its risk-weighted assets. So under Basel 3, you must have common equity, additional tier 1 and tier 2. and the total of that will be 4.5 plus 2.5 of common equity plus 1.5 of additional tier 1 plus 2% of tier 2. So again, the conventional perspective, it has 3 layers. It has some general objectives and it has some specific requirements. So now we have an idea about the objective of wealth protection from Sharia perspective and from the conventional perspective. Then we can move to discuss the capital components under Basel III, which is the specific requirements, number 3 here, because they apply both to Islamic banks and conventional banks. Okay, so now these capital components, if you can see the diagram, first you have common equity tier 1, which represents 4.5% of risk-weighted assets. And what do we mean by risk-weighted assets? It means, this term means that the assets of the bank, whether it is conventional or Islamic, will be, as each asset or each category of assets will be assigned a certain risk weight. So we will have a formula called capital adequacy ratio. You have first the numerator. In the numerator, you will have the capital components, CET1, additional tier 1, tier 2, and then you have the denominator. The denominator, you have the risk-weighted assets, where you have to calculate the credit risk, market risk, and operational risk. So common equity tier 1, it has to be 4.5% of the total risk-weighted assets under Basel III. And in addition to that, we will have the capital conservation buffer, which is 2.5%. So 4.5 plus 2.5 is equal to 7%. And later on in the presentation, this number will be very important in our discussion. So keep that in mind. 4.5 plus 2.5 of common equity. Now, the second element is the additional tier 1 capital, which will be also the focus of our discussion. Additional tier 1 represents 1.5. If you can see it here in the diagram, is 1.5% of the risk-weighted assets. And finally, you will have tier 2 capital, which represent 2%. This is not part of our discussion. So for additional tier 1, it is only 1.5%, and it is designed to absorb losses during going concern. We will discuss this term in more details in the coming slides. So basically, these are the capital components which are applicable to both Islamic banks and conventional banks. Now, after we briefly mentioned the capital components, and we know there is something called additional tier 1, and it represents 1.5% of the risk-weighted assets. Now we can focus on 4 key elements of this instrument, and we will compare these elements between the conventional perspective and the Sharia compliant perspective to see if there are any major differences. Because at the higher level, when we were talking about the general objectives, we saw some similarities, but are we going to see also similarities when we talk about the details and specifics of these characteristics that are related to AT1 instrument? This is what we're going to discuss. So when we talk about additional tier 1 instruments in the conventional banks, usually they will rely on the issuance of a conventional bond. And basically, there is nothing much you can say about a conventional bond. It's a fixed income instrument. It's basically a loan given by an investor or group of investors to the conventional bank. And the bank will have to pay back the principal at the maturity date, and will have to pay periodic interest payments. But one characteristic of this conventional bond is that it does not have a maturity date. So for this additional tier 1 instrument, there is no maturity. It is perpetual. However, the bank can buy back the instrument after 5 years. But there are some conditions that the bank needs to fulfill before the bank can do that. Needs to replace the instrument and do other things. But if these conditions are not met, then the instrument will continue and the bank will continue to pay the periodic interest payments. Only when the bank decides to buy back, then it needs to pay back the principal. The other characteristic of this instrument is that it is possible to have a share premium. So this means that this conventional bond can be issued at a premium when the demand for the instrument exceeds its face value. So this will allow the issuing bank to sell it at a price higher than its nominal value. So there will be a nominal value, let's say, of 1,000, but the issue price will be 1,100 because of the high demand. Because basically the bank is selling something, and if there is demand for this bond, then its price will be higher, and the bank can keep this premium, this extra amount, and it will be also considered part of its regulatory capital. So this is in relation to share premium. And then finally, you have going concern. So the instrument will be used to absorb losses while the bank is still in operation. We have two terms. We have going concern and we have gone concern. The difference between the two, the first one refers to a situation where the bank is suffering from losses, is meeting some or is facing some challenges, financial distress, but it is still in operation. These losses are not substantial, so it's suffering losses, but it's still in operation. So this is going concern. But gone concern, where the bank reaches the point of non-viability, it becomes non-viable. It is a stage before bankruptcy. So in this case, the losses are substantial, and in that case, another instrument will assist the bank in absorbing the losses. It will not be additional tier 1, it will be tier 2, but this will be, this is a different topic. But when we talk about going concern, additional tier 1, this bond will absorb the losses during the going concern, and we will find out how this instrument absorbs losses. What are the mechanisms that are used to ensure that this instrument absorb losses. So this is from the conventional perspective. Now from the Sharia perspective, from the Sharia perspective, we'll have Mudaraba Sukuk. So it is basically an equity investment. It is completely different from a conventional bond. An equity investment where the investor, who is a Sukuk holder, will provide capital to the Islamic bank, who will act as a Mudarib. And the bank will invest the money it collects from the Sukuk or from the Sukuk holders, from the investors, and invest it in the general investment pool of the Islamic bank. So it has nothing to do with conventional bonds. It's not debt-based, it's equity-based. The second difference in regards to share premium, there is no share premium for a Mudaraba Sukuk. You cannot issue a Mudaraba Sukuk at a premium because whatever the investor is contributing will be recorded, and that money will be used by the bank to be invested in the general business of the Islamic bank. There is no difference between the nominal value and the issuance price. This does not apply to Mudaraba Sukuk. And the third and the final difference is that this instrument can absorb losses during going concern and also during gone concern. Since it is an equity investment, and since the Sukuk holders are investing their money in the business of the Islamic financial institution or Islamic bank, they have to absorb losses while the bank is going concern and also while the bank is gone concern. So from this perspective, it's higher, its quality is higher compared to the conventional bonds. It's better quality and it can assist the bank in a more effective way in absorbing losses. Now we move to the second element or second issue in relation to the additional tier 1 instrument, the hierarchy of the instruments. So from the conventional perspective, there is a very strict hierarchy between common equity and additional tier 1. As you can see here in the slide, the common equity 4.5 plus the capital conservation buffer 2.5 equals 7%. And I said that 7% is important. We will find out soon. So this is the highest quality capital of the bank. Common equity is basically the shares issued by the bank. They are those who hold the shares are the owners of the bank. And then the second level, you have the additional tier 1, 1.5. So that's why in the conventional perspective, they consider common equity as the first line of defense. And they consider additional tier 1 as the second line of defense. Losses will be absorbed first by common equity, and then it will be absorbed by the bondholders of additional tier 1 regulatory capital instruments. When we talk about the Sharia compliant additional tier 1, we will see that it's not the case. This is not the case. So here, from Sharia perspective, there is no hierarchy at all. So we cannot say that common equity absorb losses first, then additional tier 1 will absorb losses later. Since this is an equity investment and since the sukuk holders are contributing their money to be invested in the Islamic bank, they both common equity and additional tier 1, they rank pari passu. So they are in the same level and they absorb losses at the same time. And they share the same risks and rewards of the business. For example, if we say that the common equity of an Islamic bank plus additional tier 1 is equivalent to 100 million, and common equity is 80 million, then 81 will be 20 million. So when it comes to absorbing losses, they will absorb losses based on their capital contribution. So that's why in the slide I mentioned is pro rata basis. So loss absorption will be based on the capital contribution, and the profit sharing ratio will be determined according to the agreement between the two contracting parties. It doesn't have to be according to the capital contribution. There is more flexibility in deciding the profit sharing ratio, but there is no hierarchy. They absorb losses at the same time and they share the same rewards as well. Now, so we have talked about the nature and characteristics, and secondly, we have talked about the hierarchy of the instruments. Now we talk about the coupon payment of the additional tier 1 conventional instrument. And this is where the 7% becomes important. The conventional framework, they tried to come up with a mechanism to ensure that this AT1 instrument will be able to absorb losses. And the reason why they came up with these mechanisms is to ensure that when a conventional bank is facing financial distress, will not rely on a bailout from the government, will not rely on taxpayers' money. The bank will rely on an instrument that will assist it without the need to rely on taxpayers' money. So that's why we have what is called bail-in and not bail-out. What do we mean by bail-in? That means the instrument will absorb the losses and will support the bank, and the bank will not have the need to rely on the government to continue its operation. So this is the first mechanism based on which the conventional bank can benefit from the additional tier 1 instrument. So here, if you look at the table, you will see 7%. So if the common equity of the bank is 7% or higher, that means 4.5 plus 2.5 or higher, then the bank cannot withhold any distribution to the bondholders, because basically the bank will have to pay the periodic interest payments in full. It does not have the authority to withhold any percentage of that payment. But if common equity goes below 7%, it is in the range, for example, between 7% and 6.375, then the bank will withhold 40% of the interest periodic payments. So the bank will distribute only 60% and will withhold 40%. Will use this 40% to absorb losses. So that's how the 81 instrument will be used to absorb losses. And if the common equity continues to reduce and it becomes in the range of 6.375 to 5.75, again, the bank will be able to withhold more interest payments, will withhold 60% and distribute 40%. Then if it goes below, it becomes 80-20 until if common equity becomes in the range of 5.125 to 4.5, then it has the authority to withhold 100% of the interest payment. So that means on that periodic date, if common equity in this range, on that periodic date, the bondholders will not get anything from in relation to their interest payments. And 5.125 is also an important percentage. We will also discuss it in the next slide, because this is another trigger point to enable the conventional bank to absorb more losses by relying on the additional tier 1. But for now, the first mechanism is to withhold the interest payments of the bondholders, depending on the level of common equity. The lower it becomes, the higher the amount the bank will be able to withhold from the interest payment, not from the principal. So now we talk about, from the Sharia perspective, profit distribution. This whole table does not apply. So you see the big difference between a conventional bond and the use of a mudaraba sukuk. Why this table does not apply? Because we have already mentioned that it is an equity investment, that both sukuk holders and the Islamic bank share the same risks and reward. So, and the sukuk holders are absorbing losses at the same time with the shareholders of the bank. So basically, there is no need to have this table and to have the mechanism to withhold a portion of the profit. And it's also not logical, because if the bank is doing well, then the sukuk holders will also be doing well. But if the bank is making losses, naturally, the sukuk holders will also be making losses. So there will be even no profit to withhold. So this is how it is simple and straightforward when it comes to the Sharia perspective, because we are following certain rules, certain Sharia rulings in relation to mudaraba sukuk. Then finally, we come to the final element that distinguishes Sharia compliant additional tier 1 from conventional additional tier 1. You have two mechanisms that will enable the conventional bank to make use of the principal amount of the conventional bond. Previously, we talked about the interest payment and how the bank can hold distribution of the interest payment. But now we are talking about a mechanism that will enable the conventional bank to use the principle of the instrument to absorb losses. So there are two ways. First one, under the Basel regulation, is conversion to equity. So And when does this happen? This happens when the common equity of the conventional bank reaches 5.125%. So if it reaches this point, at this point, the bank is able to withhold 100% of the interest payment of the conventional bond. And at the same time, it has the ability to convert the principal amount of the instrument into shares. And so there will be a conversion mechanism, and there will be a maximum number of shares that the bondholders will receive. So regardless of the market price of the share at that time. So it's already decided in the prospectus that if the common equity reaches 5.125 or less, the principal will be converted to shares. And this is the number of shares. This will be the only possibility for the bondholders to receive something in return for their principal. And when the principal is converted into shares, then they become also part of the shareholders. So they start also absorbing further losses. The second mechanism to enable the conventional bank to make use of the principle of the instrument is write-down. And write-down is basically to permanently reduce the principal value of the instrument. That means the debt will be written off. That's it. The bondholders will not receive anything. And the bank will use this principle to absorb its losses. This will also happen when the common equity of the bank reaches 5.125 or lower. So it has, these are the two mechanisms that are in place, which will enable the conventional bank to benefit from the principle of the instrument. Now, from Sharia perspective, both mechanisms are not applicable also, because there is no need to convert a mudaraba sukuk into equity. They are already, it is already an equity investment. And even the Basel framework says that if the instrument is equity in nature, there is no need to convert it into equity. So they are absorbing losses at the same time. They are sharing the same risks and reward, and they are basically partners with the shareholders of the Islamic bank. The only difference between common equity and additional tier 1 sukuk holders is that additional tier 1 sukuk holders, they do not have voting rights, which is still Sharia compliant. If you do not have voting rights, but you are still receiving your share of the profit, you are bearing losses according to your capital contribution, this does not violate any Sharia principle. And the other mechanism of write-down is also not applicable, because simply the bank cannot write down the capital of mudaraba. The only way the capital of mudaraba will be written down if there are losses, and these losses will be borne according to the capital contribution of the sukuk holders. So in this way, it is this instrument, the Sharia compliant additional tier 1 instrument, is structured in a simpler way. And there is the sukuk holders are benefiting from the profits generated by the Islamic bank, because they are investing their funds in the general business of the Islamic bank. And they are also accepting the responsibility of losses when the Islamic bank is making losses. But in the conventional perspective, they just brought a bond, a normal conventional bond, and they added on top of it additional requirements, additional clauses that sometimes may not be in favor of the bondholders. So these are the four key differences between the Sharia compliant additional tier 1 and the conventional additional tier 1 instrument. So in conclusion, we can say that even though at the general level or a higher level, there is common ground between, the objective of protecting wealth from Sharia perspective and conventional perspective, but when we go into details, when we study the specifics of the conventional requirements and the Sharia compliant requirements, you will see many differences, a big difference between the conventional instrument and the Sharia compliant instrument. And I used additional tier 1 capital instrument as an example for this distinction. And finally, I want to conclude with a couple of minutes by mentioning an example that happened, I think, a couple of years ago. I don't know if you've heard about it. Recently, there was a Swiss bank, Credit Suisse. It faced financial distress. And this conventional bank also had common equity and additional tier 1. So the regulator, the Swiss regulator, they asked the bank to write down the additional tier 1 bonds completely because the bank reached the point, I mean, the common equity went below 5.125%. And as a result of this, they used the mechanism of write down. So completely the principle of the instrument was wiped out. But after the instrument was wiped out, this bank merged with UBS, another Swiss bank. And as a result, the shareholders, they managed to get something in return. So now the hierarchy became inversed. It became the opposite. AT1 did not get anything, but the common shareholders, they got something in return because their bank merged with UBS. So even the conventional methodology did not work. As an example, this is an example of a real life example. When a bank faced financial distress, it became the opposite. AT1 did not get anything in return, and the common equity holders of the bank, they managed to get something because their bank merged with UBS. So of course, this created a lot of discussions in the market and a lot of debate and criticism. But at the end of the day, we can say that there are major differences between the conventional perspective and the Sharia perspective when it comes to the specifics. And we have to bear in mind that these differences are highlighted to ensure that the Sharia compliance of the instrument, so that we will not be in a position where the conditions of the conventional system are imposed on instruments that are used in a Sharia compliant way, because this will affect the nature of the instrument, will change its characteristics, and at the end of the day, the instrument will not achieve its objective. So with this, I end my presentation, and I thank you very much for your patience. Thank you very much.
Thank you very much, Dr. Madaa. Really, we appreciate that you took your time to present your research, and also I hope you get better from your condition.
Thank you very much.
Alhamdulillah. Alhamdulillah. Thank you very much for joining. And of course, we do thank everyone who joined today, our research forum. And we hope that you'll continue supporting us and visit our or tune into our research forums in future, inshallah. So all the best, and thank you very much again. Assalamu alaikum wa rahmatullahi wa barakatuh.